We'll go right into the lion's den here and talk about the gold market and gold price suppression. So now here they are. So let me introduce the BullionStar here today. You have Mr. Zane Lim, who's the regional manager of operations. Vincent Tai is product development manager, and Malin Persson is chief financial officer, and she also doubles as my wife. Quite convenient at times. All right, so let's get started. I first want to cover a bit about the gold market, gold price suppression. You know, gold has been going up about 400% in terms of fiat money since the turn of the millennium, but still a lot of gold bugs, a lot of gold savers are complaining about price manipulation. They're saying that the price is suppressed by, you know, bullion banks, central banks, and so on. So let's look into that first and see what is there to that. Then go back a bit and talk about the fractional reserve banking system, which is our current monetary system, and the US dollar as a reserve currency. Then take a short break, 10-15 minutes, and get back to talk about inflation, deflation, monetary supply, monetary demand. Where do we stand right now? You know, we have, since 2008, I would say we have a mild deflationary pressure, which is not the same thing as saying that we have price deflation, because we don't, we have price inflation. How can we have deflationary pressure but still have price inflation? Talk about hyperinflation, can that happen again? Can that happen in our era? And conclude by looking at gold, the future role of gold. Can gold once again be money? Can it once again be a reserve asset? I will also leave some room, hopefully, for discussion at the end. So feel free to interrupt me if you want me to clarify or break something down, but we'll leave some room for you know, comments and questions at the end. Let's start with the gold market. So I'm going to talk about first the physical gold market, because it's an important distinction here between the physical gold market, that is real gold and silver, and the paper gold and silver markets. But I will start with the physical gold market. So if we look at global production per year of gold, we have about 2,800 tons produced each year. Total market is about 4,400 tons, with the difference made up by recycling. So we will try to keep this in mind. You have 2,800 tons of gold produced each year. And the value, in terms of the dollar value, of the 4,400 tons is about 190 billion US dollars. If we compare it to, for example, the stock markets, do you know how much is traded on the stock markets globally each year? How much is traded on the stock markets globally? It's unimaginably big. The sovereign debt markets, all government debt, you know, US bonds, European bonds, the value of the sovereign debt market is also about 70,000 billion US dollars, about 70 trillion. So, you know, looking at the gold market from that perspective, the gold market is very small. And even if we look at all gold ever mined in the history, which is about 175,000 tons, that is worth about 7.5 trillion US dollars. But of course, a lot of this has gone into hiding already. You know, there's not a lot of this gold flowing on the market. If we look at the total money supply, you know, the total value of all fiat-denominated assets. I should explain fiat. I will talk a lot about fiat-denominated assets and fiat money. So fiat is a Latin expression, which means let it be. So fiat money is basically money created out of nowhere, just coming into existence magically somehow, being loaned into existence. So that is what is meant with fiat. But the value of all fiat-denominated assets in the world is different figures, but anywhere from 600 to 1,500 billion US dollars. Trillion, sorry. You know, those are large figures. It's difficult to actually. It's a trillion. So 600 to 1500 trillion US dollars for all money in a broad sense. So gold at best actually covers 1 to 2% of all outstanding fiat assets. So that was a physical market. Let's now look at the paper gold market. The biggest market for paper gold is the London Bullion Market Association. They did a survey in 2011 among its participating members. The members of LBMA are clearing banks, so JP Morgan, HSBC, other big banks. They did a survey in 2011 which revealed that 2,700 tons of unallocated gold was traded each day on LBMA only. And it was only 2/3 of the clearing banks actually replying to the survey. And this is the best figure we have. The LBMA market is the biggest paper market in the world. And 2,700 tons of unallocated gold per day. Put that into perspective. We have 2,800 tons of gold mined physically every year. But still, it's 2,700 tons paper gold traded each day. It's anyone's guess whether this paper gold is backed by physical gold. And this is not even taking into account other markets, the commodity market, COMEX, other future markets, other spot markets, certificate markets. So the paper gold market is huge, but it's just ridiculous how much paper gold there is compared to physical gold. And it's anyone's guess of a ratio, it might be 10 times, it might be 100 times, it might even be more paper gold than there is actual physical gold. But the important thing here is that the paper market is the price discovery market. So it's actually supply and demand on the paper market that sets the price. And the paper gold can be created basically out of nowhere. I will get back to how it is created, but it's important to remember that price is set on the paper gold market, and it's then inherited to the physical market. So we can see this year, we've had the spot price of gold decreasing about 30% from January to the bottom in July this year. So then the question is, what can trigger a price decrease on a normal market? Well, it's quite simple. You either have a higher supply and constant demand, or you have constant supply and you have a lower demand. Then the price can go down on a normal market, right? It's quite basic. So the question is, here we have a gold market. Physical gold market is quite stable supply. We know that mine production is about 2,800 tons per year. So then, has physical demand for gold, bullion, and jewelry been going down, triggering this price decrease? No. No. Hell no, I was going to say. It's my presentation, I can swear. No, the demand for physical bullion and jewelry has been sky high, actually. It's been overwhelmingly high. And this screen, I can vouch for that in my companies, but also all competitors and all, the physical gold market is experiencing the same thing. And also World Gold Council is writing about this in their report. So it's global, but especially in Asia and Southeast Asia, it's record high demand, making the price premium, that is the portion of the price above the spot price, to go up. So, how can a record high demand actually result in lower prices? Well, let's look at the paper market again. The paper market has been losing in popularity. It's especially the Western speculators that are selling their paper gold because they say the trend is now, the trend is negative, so now it's a good time to sell paper gold. But it's also a lacking confidence of paper gold. You can see that underlying problems in the Western economies with record high debts are making people requesting physical delivery. So there's a change from people trading in the paper market to the physical market. So my take on why the price has been going down this year is that there has actually been increased demand for physical gold. Increased demand for physical gold has made the price go down, because this increased demand for physical gold is corresponding to a decreased demand for paper gold. So people are losing trust in the paper markets, and they're shifting to the physical market. But it's the paper market where the price is set. So, how upside down is this world? You know, you have increased demand for something, for real physical gold, but the price goes down. But that is because of the paper market, because that's where the price is set. Right. Let's now look at the price of oil. We can see that the oil price here has been going up quite a bit over the last decades or so. But what if you look at the oil price in terms of gold? You see it's been rather stable. It's fluctuating a bit up and down. It's been rather stable since 1950s for about 60 plus years. And this is, the reason I'm bringing this up is because this is very important to understand how the gold market has evolved from the 60s and 70s. What's the reason why the price in oil has been so stable if you measure it in gold? Well, of course, gold is a more stable unit of account than US dollars, for example. But that's not the whole picture. There's something else to it. And, you know, if you put yourselves in the clothes of the Arab oil barons for a minute, say that you're selling oil, you know, you have a huge surplus, you have huge savings. So you buy a couple of private jets, you buy your Ferraris, you buy whiskey, you buy wives, I was going to say, you buy all the things you can do for your oil money. But then you still have a surplus, so you want to save the remainder. Would you then prefer to save it in, you know, US dollars or some fiat currency? Or would you prefer to save your generational wealth in something else? Of course, the purchasing power of the fiat money has been losing about 98% in 100 years. So that is not a good option for generational wealth. You can invest on other markets, but then you have risk. So, you know, the answer is gold, of course. They want to be able to sell their oil in gold, basically, but you have a US dollar in between. So a prerequisite, basically, for the oil barons selling oil is that they can convert their US dollars to gold. And this is very important, because they don't care too much about the price of gold. It's just that if the price of gold is low, then they'll be happy to keep the price of oil low. But if, as we saw in the 70s, the price of gold goes up, then the price of oil also goes up in tandem. Because we could see the chart here, we could see that the chart was quite stable. So every time the price of oil has been going up or price of gold has been going up, the other one is also going up. So they're correlating. They are going up and down in tandem. And, you know, why is this important? It's important, of course, because in the West, what are the implications, generally in all growth economies, you know, what are the implications of a high oil price? It dampens growth, so it's no good. And, you know, the West is much better off with a low price of oil. But to keep the price of oil low, you need to keep the price of gold low, because the oil producers are interested in getting gold. If they just get US dollar without any convertibility to gold, they wouldn't be too interested. So that is what happened in the late 60s and 70s. They you know, when you had the economic problems in the late 60s, beginning of 70s, with a lot of money printing, especially in the US, and, you know, price of gold went up, but price of oil also went up. So the oil producers will make sure that if the price of gold goes up, the price of oil will go up. What we could see in the 70s, of course, was that the Fed chairman, Paul Volcker, stomped out inflation, and there was a policy of a strong US dollar, there were high interest rates. And this took some bidders off the physical gold market. It was restoring a bit of confidence in the markets. But still there was too many gold bidders in the physical market in the 70s to keep the price of gold low. So more bidders for physical gold had to be removed from the physical market to keep the price low. So the brilliant solution of how to, you know, multiply the supply of gold was to create the paper market, the gold paper market. And, you know, they had the brilliant justification for this, because, and it was perhaps in a sense justified, it was the miners that could actually forward sell their gold. So what happened was that, you know, a gold miner could get funds today for producing gold in the future. So they forward sold their gold with a promise of delivery in 2 or 5 years, or whatever time frame it was, you know. So they'll get money today, and their counter part is that they will actually deliver the gold in a couple of years' time. And by creating this futures market for gold, the supply multiplied. And this was in the 70s. And of course, if supply is multiplying, you still have the same demand, prices going down. So with the price of gold going down in the 80s, the price of oil could be low. The oil barons are just happy to convert their oil to gold, whether the price of both are low or high. So this is sort of the secret of, that was actually the secret of catalyzing growth in the 80s and 90s, to keep the price of oil low, and then they also needed to have the price of gold low. But in the late 90s, there were a lot of problems building, you know, more and more debt, oil was getting scarcer, and monetary inflation. So it was not enough with the futures market. So the central banks actually became primary suppliers, selling central bank gold on the market. And the central bank selling gold on the market was perhaps not the most important thing. The propaganda around it was more important. It was big selling announcements. You know, they were going to sell a couple of tons of gold, which the market could easily have absorbed, in my opinion. But it was big propaganda because everyone wants to front run the central bank. So if you know that the central bank is selling 100 tons of gold at a specific date, then you want to sell before the central bank, and that is sort of adding to the sales pressure. So that's what happened in the 90s and in the beginning of the 21st century. Concluding this, we can see that the overwhelming majority of all gold traded the last 40 years has been on the paper market. And the paper market keeps the price low because paper gold can be created just out of thin air. If a physical gold market would set the price, you know, the physical gold market again is very, very small, and there's so much paper gold traded. If a physical market would set the price, it would have to be much, much higher, of course, because otherwise there would be no incentives to get the gold out of hiding. There would be no gold flowing whatsoever. So it's actually the creation of the paper markets and the unlimited amount of paper gold that seduce the price of real physical gold. And remember that the increased demand for physical gold can actually correspond to the price going down, because when we have an increase of demand in physical, it means that there's a lack of confidence on the paper market. Let's now go back a little bit and briefly look at the basics of our current monetary system, fractional reserve banking. I focus a lot on the US and the US dollar, which is it's not preferable always, but the reason is that the US dollar is the reserve currency of the world, and therefore I don't have much choice actually. But I will try to blend in some local Singaporean information as well. So let's briefly look at what is money really. Money serves 3 basic purposes. The first one is as medium of exchange. It's quite natural. So money is actually the intermediary between the exchange of goods and services. If we don't have money, we're back to medieval times, barter, which is very impractical. If I have a cow and you have 100 chickens. I want to buy a chicken, but my cow is worth 100 chickens. How am I going to do this? It's very practical. But with money, I can slaughter my cow and then sell it to someone that can distribute it, and then I can buy a chicken and save the other 99 units. So this is sort of origin from money and the most essential thing. The second one is unit of account. Unit of account just means frame of reference, basically. So when we in everyday talk, we're talking about $10. Someone else is saying, oh, $10 for that is very cheap, That means that we have a common reference, which we use for everything, for budgeting, for accounting, as a frame of reference. Third one is store of value. And this is, of course, where the current money has been failing a lot. Store of value means that if I put in this $1,000 note in a safe deposit box for 20 years, will it still have the same purchasing power in 20 years? You know, what if I put in this 20-gram gold bar? This is equivalent to about $1,000 today. You know, what would you actually prefer? Would you prefer to put in this in a safe deposit box for 20 years? Or maybe the piece of paper here? Who prefers the paper, you know? And who prefer gold put in a safe deposit box 20 years? Well, I think that's the reason we're here, but gold, you know, looking at history, gold has been keeping its purchasing value much better than fiat money, of course. So let's look at the characteristics of money. How does money need to be characterized to serve these purposes of money? First one is durability, meaning that money should not corrode, it should not oxidize, it should not burn. This burns pretty well, actually. I wouldn't burn these, but not these ones either. But yeah, they burn quite well. They can be deleted because most of the money today is only electronic, can be deleted easily. But the durability of the 20-gram gold bar is much better. You know, this can be sure it can be melted, it can be split, but you still have the gold. It's not destroyed as easily. Second one is possibility to move. I can move both of these quite easily, and the electronic counterpart to these I can move really easily. But again, you know, we're sitting on the delete button. You can also delete it quite easily if it's just digits on a bank account. What would you do if you log into your bank account online? It just says 0. You had $100,000 there, say. It says 0. You go to the bank doesn't know anything. What are you going to do? You know, it's quite scary. Many people are not considering that. I know you would be, but it's very fragile system. Gold is actually divisible. It can be split. I here have a 1-gram gold bar, which I'm going to do a small experiment with. I'm not going to destroy it. I'm just going to divide it into 2 equal, hopefully about 2 equal pieces. So now I have 2 gold bars. It's as easy as that. That's how they're creating fiat money. They can just split it endlessly. Also, one is actually about 0.6 gram, and this one is 0.4. But I still have the same value here, right? Because I still have the gold. So it's very divisible. I can split this and still have 1 gram of gold, but I have 2 about equal parts. So I still have 2 units of gold, 0.5 gram or so each. What if I split a $2 note? And I don't know, do any one of you know whether it's actually illegal to do that in Singapore? Some countries it's illegal to destroy money. Do you know? It's illegal? Yeah. So I don't want to be illegal in Singapore, so let's not do it. Let's just pretend that I'm splitting this into 2 parts. What do I get if I split a $2 note to 2 parts? Do I get 2 $1 notes? No, I get 2 worthless pieces of paper. Well, that is not worth anything. If you collaborate and you put it together and go with it to a bank, perhaps, you know. But that just tells us how worthless the money is, because, you know, it's just pieces of paper. It's actually cotton and something else synthetic. It's actually quite difficult to split these. I don't know if you have tried. They put something into it. Yeah, plastic. Oil again, you know. Fungibility, fungible means that if I loan out 20 grams of gold to someone, I don't expect to get back the exact same unit of gold with this serial number here. Any 20 grams of gold would do just fine. Same with fiat money. If I loan out $1,000, you don't have to give me this note back. You can give me any money. Intrinsic value is, you know, gold is gold has a value because it has superior metallic characteristics. It's very dense. It's dense but soft. It's malleable, meaning that it can be stretched out without breaking. So, and it has a history, of course. It has a history of 6,000 years or so. And you know, it's been used a very long time for tools and for purposes. And you know, the history with the fiat currency is that you have some boom and bust, and then you have destruction of the currency. No fiat currency has survived for more than, you know, a couple of hundred years ever in history, whereas gold's been around for 6,000 years. So let's look into what we have today, the fractional reserve banking system. So actually these the notes here, that is only about 3 to 7% of the total money supply in different countries. Singapore is about 5.5% of the total money supply, which is made up by notes and coins. In the USA it's about 7%, and in Sweden, where I come from, it's about 4%. But how about the Western money, about 95%? They just exist as an electronic liability. They just exist on a bank account as a figure on a bank account. And if I think you're pretty well versed with this already, you know, but if you don't know it already, this is the most important thing you can take away from here. How is those 95% of the money supply created today? It is just created. It's created out of thin air. The money is actually loaned into existence. So when someone goes into a bank, illustrate here, you have Robert here who buys a house. The house seems to be in a bubble, you know, it's different ideas about that, especially in Singapore. Anyways, Robert here goes into to the bank because he wants to loan $1 million. $1 million it would be cheap in Singapore, of course. You would say, I'll take 5, you know, it's very cheap. Anyways, Robert goes into the bank. He wants to loan $1 million for his house. The bank is judging Robert after his credibility. Usually if he's wearing a tie, he's fine. You know, that sort of thing. And, you know, speaks properly. So the bank will extend him a loan of $1 million. And the important thing here is that that $1 million just came into existence when the bank actually extended the loan to Robert. Sure, the bank needs some small reserves to be able to loan out the money, but the money didn't exist previously. There's no counter performance for a bank to create loans. It's just coming into existence. The money is loaned into existence. It didn't exist previously. So that is actually how the majority of our money is created today, by private banks loaning them into existence. And the terminology here is really incorrect because it's not really a loan. You know, if I loan out this tool, I would expect to get it back, hopefully. It's a loan. But nothing is loaned out by the banks. There's no counter performance. It's just created. It's not a loan really, you know, it's just a creation of the money. So how did we end up with this, you know, in my opinion, crazy system? We need to look at the monetary history, and especially the history of the US, since that's the reserve currency of the world. Let's start with the War of Independence in the late 18th century. What was that all about? Well, you had the English people had quite substantial war debts, and they wanted the American colonies to pay a lot of tax to cover for the English war debts. The colonies didn't like it too well, so you know, after sending off a fair bit of the gold and silver already to the English, they instigated their own money, scrip money, token money. And the English didn't like that. They would have preferred them to use the English banknotes, because then the English bankers could create the notes and then they could charge interest on them. And so this is the summarized version. But it ended up with a war, and the Americans basically kicked out the British bankers, and they made sure that this is never going to happen again, right? So they wrote into the Constitution, no state shall make anything but gold and silver coin tender in payment of debts. So the American Constitution is very clear that it can only be gold and silver that is actually money. So the US dollar was created in the late 18th century. The US dollar is actually a weight measurement. It's actually just like a weight measurement, just like the gram or the troy ounce. It was originally 24.06 grams of silver when the US was on the silver standard. Subsequently, they moved over to the gold standard when it was about 1.5 grams of gold. And that is actually where the historical value of gold is 20.67 US dollars. And 20.67 times 1.5 is 31.1, which is 1 troy ounce. So a lot of figures, but the dollar was not ambiguous like it is today. It's not like, you know, losing purchasing power, inflation. It was a weight measurement of first silver and then gold. That's how it's originated from the beginning. And that, you know, in the 18th and 19th century, after the US Constitution, the banks were just intermediaries between savers and borrowers. The bank couldn't, you know, create any of this funny money. They just had to loan out with what was deposited into the bank. And if you look at the price inflation since the late 18th century, we can actually see, except for two wars, the War of 1812 and the Civil War, 1862, the US dollar actually fared quite well with a tendency for deflation. This is actually price deflation. It's important here to remember that inflation, the definition of inflation is when the monetary supply is increased. So you have monetary inflation, which is causing price inflation. This is price inflation. But you can see that there was actually a tendency for deflation throughout the end of the 17th century, 18th century, and nothing much happened from 1865 to 1930. 1913 was the next major event. We are this year celebrating 100 years since the creation of the Federal Reserve. The Federal Reserve, you know, the banks have been lobbying a whole lot since the late 18th century, wanting to be able to create banknotes again. They've been lobbying, and they were successfully doing that again with the creation of Federal Reserve in 1930. But it took some 100+ years, and that paved. So the Federal Reserve is the American Central Bank, which is just a private banking cartel, basically. It's nothing. It's usually said that it's not more federal than Federal Express. You know, it's a private banking cartel. But that paved the way for a new monetary system, for the fractional reserve system. But the next significant event here was the abolishment of the gold standard in 1933. So previously, US dollars could actually be converted to real physical gold. But with the abolishment of the gold standard, it could only be exchanged internationally. So even after 1933, international central banks could go to Federal Reserve and say that they wanted to have their US dollars exchanged for gold. Up until 1971, when we had the Nixon shock, meaning that President, you know, the late 60s, the US had a lot of debt, you know, they were funding the Vietnam War, and they were printing a lot of money. And the international central banks, they started to question whether, you know, they could still exchange their US dollars for gold. The US said that the dollar is just as good as gold, we will defend it to the last ounce and so on. But it didn't go on for very long until you know, President Nixon declared that gold could temporarily no longer US dollars could no longer be exchanged for gold. Temporarily, he said in 1971. So temporarily has now been 42 years or so. And they also blamed it on the evil speculators. So since the Nixon shock here, we can see that the chart is just going to 2005 or so, but inflation has been no deflation here since basically since the 1930s or so. It's just been, inflation's been the name of the game here. So the US dollar is the de facto reserve currency of the world still. And it's important here to look at how something can be a reserve currency. To be a reserve currency under our current monetary system, fractional reserve, you actually need to have more imports than you have exports. Because that's how you distribute the US dollar to the rest of the world. You have net imports, so you have to pay for those net imports. And this is called the treating dilemma. And the dilemma is, of course, that running trade deficits, importing more than you're exporting, you're going to have an increasing level of debt all the time. And normally, under normal market conditions, the US dollar would depreciate in value, which would make exports cheaper abroad and imports more expensive. But since the US dollar is demanded as a reserve currency, that doesn't actually depreciate as much as it would in a free open market. So this is called the treating dilemma. So we'll take a short break here, and after the break I want to talk more about monetary supply and demand. Where do we stand today? There's different camps here, inflationary and deflationary camps, and people have quite strong opinions about inflation, deflation, and hyperinflation. We looked at hyperinflation. Can it ever happen again? We'll take a short break here. You can see here that the main holders of these US bonds. Actually see that the federal US government is the biggest holder. So they're holding their own bonds. Very convenient. It's monetizing the debt. It's printing money. Federal Reserve, same thing. We'll come back to that. China is the biggest foreign holder of US bonds with about $1.3 trillion worth of bonds. But the interesting thing on the US bond market is that even though the US has had a deficit for the last year, about $1 trillion, even though they have this big deficit, the foreign holdings of US bond has not increased significantly during the last year. It's basically the same level as a year ago. So the foreign appetite for all those bonds, for all this debt, is decreasing. So the question is then, how do they fund their enormous budget deficits? This chart will give you an idea. This is the American Central Bank Federal Reserve's holding of US Treasury securities, so US bonds. You can see here that when the foreign appetite has been going down now during the last year, the level of debt held by the Federal Reserve is just skyrocketing. And this is what's called QE, quantitative easing. This is printing money. So the US Treasury is issuing a bond to cover for the deficit, and the bond is purchased by Federal Reserve. But the Federal Reserve didn't have the money. It was just created when it was deposited into the Treasury's account, and then the Treasury is paying with all their expenses. And now it's a lot of talk about tapering and whether the Federal Reserve will slow down on the bond purchases or even quit it. But there can only be two scenarios where the Federal Reserve can stop buying US bonds. Even the US government has to start to balance their budget. And just what's called mandatory spending, which is excluding, for example, the military. Mandatory spending is just included what is written in the law that the US government has to do. The military is not included. Even with those mandatory spending, the cost is actually higher than the revenues they get in from taxes. So what's the chance of the US balancing the budget? Even if they take home all the soldiers, they close down their bases in 170 plus countries, they stop the wars, they fire their military, they're still going to have a deficit. So it's not it's no chance of the US balancing the budget. Obama now is saying that, it's great because the budget deficit is decreasing quicker than ever. Well, it's because it's been bigger and is bigger than ever before. So the other thing is if the foreign appetite returns from US bonds. But we can already see that the main exporters, you know, China, Brazil, Germany to some extent, Russia, but they are not interested in buying more US bonds. They have enough, so they try to diversify their holdings, not by selling the existing bonds, but for the new surpluses, they buy other stuff instead, tangible stuff. So what if Fed actually started to taper here? You know, foreign appetite has already decreased. The US is not going to balance their budget. Yeah, the Fed is starting to taper, and they won't be buying as much bonds anymore. What would happen? Interest rates would get sky high for there to be any sort of appetite for bonds, because the interest rates would have to be much, much higher on a normal market to justify the underlying risks. But with the interest rates going higher, then the US would be underwater right away. All the revenue would just go to pay the interest. And then you would have, basically, you would have a lack of confidence and hyperinflation very quickly. I mean, the Federal Reserve cannot taper. I think it's just, it's rather silly, you know, if you look at the underlying fundamentals, it cannot stop. And with all this money creation, of course, we can see what's happening to the purchasing power of our currencies. It's similar to, it's the inverse of the chart I had before. We can see here, with the instigation of the dollar here, 1774 or so, we had the war periods, the US Independence War, War of 1812, and the Civil War. We had monetary inflation, because those were the only times when money was actually printed, banknotes were used, which had no redeemability into silver and gold. But in between those periods, the dollar fared quite well, and we can see even up here until around 1913 or so, the US dollar still had the same purchasing power as it had when it was initially created. But after that, for the last 100 years, it's lost about 98% of its purchasing value. Which means that if something cost $1 100 years ago, it would cost $50 today. So money's role as a store of value here has been eroding tremendously. You can see that it hasn't been faring very well. So the holders of the US debt, the main exporters, they understand this, and they want to diversify. So why don't they just buy gold? Gold's been stable for thousands of years. And we remember that the gold market, the physical gold market, is about 190 billion US dollars per year. China alone holds US bonds only for 1,300 billions. So it's impossible for them to buy gold at the current valuation, because the value of gold is just too low. And they can't really diversify their existing holdings, because no market is big enough. You know, US bonds is the only market where you can place big bulk of capital. All other markets are too small, basically. So we can also, it can be interesting to see here, Singapore. Singapore here it's quite interesting. Their total gold reserve is 127.4 tons, which is only 2% actually of total foreign reserves, which is quite low actually. I don't know if anyone here knows Singapore's official policy on their gold holdings. I haven't studied it in detail. You would think that, you know, with the GST exemption, they're trying to encourage companies to set up here with precious metals, that they would actually start to try to get some more gold in their foreign reserves here, but not so far. So we can see that it's not possible for the foreign US bondholders to buy any gold really. They can pick up bits and pieces. And they are, because this is the central bank contributions to demand over the last quarter's physical demand of gold. And we can see here that the central banks are actually net purchasers of gold now. They're buying around 100 tons per quarter. And it's the Asian countries, and it's the what's called the CIS countries, that is the old Soviet provinces, you know, Russia, Kazakhstan, Turkmenistan, Tajikistan. They all buy gold. They are surplus countries. But if China, for example, or anyone else that has big bunch of US bonds, if they were to buy gold quickly, there would be shortages. There would just be no gold because, you know, remember that the price of gold is set on the paper market, so the price doesn't necessarily rise when physical demand is increasing. So it would trigger quick shortages if any major central bank would buy large amounts of gold on the market. And with that, you know, we might very well have hyperinflation quickly because it would be a lack of confidence in the debt markets. But I'll get back to that. So let's look at the demand and supply of money here. So since 2008 in the US and in Europe, the economies have been struggling. We have a mild deflationary pressure, in my opinion. That is, we have, you know, loans defaulting, we have high unemployment, we have, you know, businesses going bad. And in this situation, the first instinct is that people save more money. They want to hoard money for these uncertain times. But let's look what's happening on the supply side. Because when there is a higher demand for money, you say that there's always demand for money, but when I talk about demand for money, I mean demand for saving money. So demand for saving money, as opposed to consuming the money, is actually increasing in uncertain times. So we have seen an increased demand of saving money since 2008. So what does the other side do? The central banks, the suppliers, they just release more money. They always make sure there's enough money. So basically it's a tug of war, you know, the demand side is pulling and the central banks are just releasing more money. This is QE and other measures, basically. So we have a deflationary pressure, but we don't actually get any price deflation because there's just more supply of money all the time. And that is what we have seen over the last year. So the situation here is basically that the deflationary pressure met by money printing, and with the money printing, you know, remember that all those money are created as debt. So the underlying problems are actually getting worse and worse all the time. And the increase in money supply, for it to work over the long term, this increase in money supply really has to also come with an increase in the confidence of the one who's issuing all the debt. But we can already see that the foreign holders of, you know, US debt, they have lost their confidence already. So they are not increasing the holdings of US debt anymore. Let's now look at hyperinflation. I think hyperinflation is quite poorly understood normally. You can see the Zimbabwe note here. You have $100 trillion. This was, the same day it was issued, it was worth about 3 eggs on the market, and a couple of days later it was worth less. But hyperinflation is not the same as more inflation. Hyperinflation is not triggered by the supply side. So even though they are printing a lot of money to meet the demand for savings, that won't lead to hyperinflation. Because you even have, you know, inflation is the stability, relative stability in the fractional reserve banking system. Even the central banks, they have their inflationary targets. They're saying 2% inflation is ideal. But by saying that, you know, they want this 2% inflation, of course the money is created, you know, as debt, and then the underlying debt situation is just getting worse and worse. But hyperinflation, what is important to look at here is the demand side. So let's look at Zimbabwe again. What happened there? Yeah, you have a lack of confidence in the money. So you're getting paid perhaps twice a day. You literally run out and spend your money before they are becoming worthless. So you don't have any demand for savings because you have a lack of confidence. So this is what's important to watch now. You know, the demand, we're still in the first phase, so the demand for saving has actually been increasing a little bit over the last year. But with it, we have raising debts all the time, so the underlying problems are getting worse. So the next important thing to watch for is the decrease in the demand for savings, because that is the same as saying that there's a lack of confidence. And then we are approaching hyperinflation, but we're not there yet. So if we look at the bond holdings again. If China, for example, would start to sell large bulk of their existing US bond holdings, then we would have hyperinflation quickly. Because who's going to buy those bonds? There's going to be a total loss of confidence. But it's not in their interest to sell any of their existing debt, because China's holding 37% of their total foreign reserves are actually in US bonds. So if they just sell a little bit too quickly, the rest of that portion will be worthless. But, so this can happen by itself, actually, that, there's a loss of confidence in the money. But I think it will also be connected to gold, and I will get back to that shortly. But remember that it's not only the supply side. The supply side is building up, the problems with more and more debt. But then it's important to look at the demand side when there's the confidence loss. But I think this will be connected to gold. So let's now look at gold and gold's future. What can we expect from gold in the future? Can gold once again play the role of reserve currency? Can it once again take a predominant position on the international arena? Sure, the paper gold markets, they might survive a little bit longer. But here in Asians, I was going to say we Asians, but I've just been here 4 months, so I don't think but here people inherently understand. It's quite good here, because people inherently understand gold's role as money, really, as value retainer. And they save in gold here. It's not really investing in gold, it's more saving in gold. You have an excess, you have some surplus, and you save away a little bit. This picture is from China. They had some promotion this spring when it was sky-high demand for physical gold. It was actually 10,000 people that was reported to stand in line outside a jewelry shop in Shanghai. They were selling gold jewelry, I think it was spot plus 9%, which is much higher than we suffer. but still people were queuing up, thousands just to take advantage of this. So what's happening here is that Asians are actually putting a mind value to real physical gold that is higher than the paper price. They understand here that, the real value of gold is much higher because the paper markets are actually suppressing the price. So whereas West sell paper, the East buy physical. So we have also a net shift where a lot of physical gold goes now from West to East. You can see it here in Singapore with a lot of banks setting up vaults, or they're actually buying room in the Freeport, most of them. But we have this big trend shift. And also, the surplus countries, like I said, China, Russia, they're trying to pick up bits and pieces for their foreign reserves. One important thing is also that there's commodity exchanges appearing now. There's a commodity exchange both in Shanghai, and there's one in Russia now, I think, as well, setting up, where you can take physical delivery of gold. That's what you're supposed to be able to do at a commodity exchange. I've been trying, actually. In 2008, there was a big shortage of silver. I set up Libre Silver in Sweden in 2008. So big shortage of silver. The silver price was below $9 per troy ounce, whereas the premium for physical silver was sky high. It cost about $17 or $18 US dollars to buy a silver ingot. So I wanted to take delivery from COMEX, from the commodity exchange in the US. I investigated it quite in detail, actually. But it's basically impossible. It's a lot of bureaucracy. It takes several months. It's very costly. It's clearly constructed for cash settlements. It's not constructed so that you should be able to take physical delivery. It's very discouraged. And I ended up not doing it, even though I did put quite some time into it. And because it's just too bureaucratic and too risky. And they're also setting up similar commodity exchanges now in Russia. I should not say similar, because it's dissimilar, because you can actually, I heard that 40% of the contracts this spring on the commodity exchange in Shanghai was actually going to physical delivery, whereas in the US it's less than 10%. So the question was whether gold can actually replace the US dollar as reserve asset. a store of value. And my answer is that gold will inevitably replace fiat as debt as store of value. Well, we could see that on LBMA, spot market, the same amount of gold is traded each day as is produced for a whole year on the physical market. So the biggest threat to this paper gold market, to the unallocated paper gold market, is people taking physical delivery of real gold. It has to break down soon. We could see this spring, we had tremendous difficulty in acquiring any gold and silver whatsoever this spring because the physical demand was sky high, but the price went down. And we just need a marginally higher amount of traders requesting physical gold, generally or from their paper gold. And this house of cards will collapse. And this is the important event, in my opinion, because when there's no physical gold available anymore, the paper gold market will settle on the last spot price, but physical gold will be revalued. You can express it as an infinite supply of US dollars meets zero demand for physical gold. That is basically saying that no one wants to sell gold anymore because, there's not a lot of gold sold now already. And with people understanding that there's a total different value for physical gold than paper gold, and no one wants to sell, so it will have to be revalued significantly. And I think that this will be the starting point of things going really bad. There will be a shortage of physical gold. And remember here that the gold has all the time, really, since the 70s, been backstopping gold. Without the convertibility of US dollars into gold, the US dollar would basically be worthless. I was talking about the oil barons, but more generally, so gold is sort of backstopping the US dollar. So a lack of confidence would arise from there being a shortage of physical gold. So if fiat currencies can't buy gold, the confidence for the integrity of the fiat system will go down the drain. And then to induce any sort of flow of physical gold, there will have to be a revaluation of gold. And with that, the fiat currencies will depreciate a lot. And that is the important point here. The shortage of physical gold together with a decrease in the demand for savings, that is what we need to look out for the next stage. Will we then get rid of the central banks finally? No, I don't think so, unfortunately. Because many central banks will actually fare okay in such a transition. The reason being that the central banks are already holding gold, of course. But if the foreign reserves, mostly US dollars, are becoming hyperinflated and becoming almost worthless, then if they also hold gold, that wealth will just be shifted from the fiat-denominated assets to gold. So the balance sheet will actually do okay for the central banks, for the ones who has gold already. And I believe that the central banks actually understand this. Because the central banks are stocking up on gold. China, we saw that they only have 1,054 tons of gold currently, but there's a lot of speculation that they have increased these quite significantly over the last years. Speculators saying that they now have 3,000 to 5,000 tons, but they don't update their holdings more than every 5 years or so. So the last update, I think, was 2009 or so. But I think the central banks understand it, and you can see it from, in ECB, the European Central Bank in Russia, they're already marking gold to market, meaning that on their balance sheet, they actually input the value, the spot market value of gold already. So it seems that they are in a way prepared for this. So if gold will be revalued and fiat-denominated assets will be depreciating, then if the central bank has gold, they would still be faring okay. So in this way, gold might very well recapitalize the system in such a scenario. And after this revaluation, everything will be much easier because gold is so much easier. You don't if you have fiat assets, it's always a claim for someone else it's always you always hold a claim, you know. It's just a mere promise of someone else paying you back. It's not backed by anything. It's not tangible. But gold is the ultimate debt extinguisher. Gold represents payment in full. The transition period might be a bit chaotic, you know, but we're still left with the real world, you know. Everything, equity after this revaluation, I imagine, you know, being based on real things, you know, real tangible assets we will still have. Everything here will still exist. So it's just that gold needs to recapitalize the system. It needs to have a much higher value in terms of purchasing power, because this, we were looking at gold in comparison to other markets, and the value of gold is too small to be able to function as a reserve currency, so it will have to be revalued. And, you know, sure, we are currently educated into our current system, our debt-based illusion, but everything will be much easier to understand after this transition. And it will also give birth to a meritocratic society where everyone would have to live within their means, or they have to consume their savings. That is basically the sort their goal. So with a gold-based reserve as a store of value, you can't live beyond beyond your means very long, or you have to disorder your gold. Because currently, of course, just to keep up with inflation, you need a return on your investment. You actually need to take a risk to just keep the purchasing power of money today. That's not, you know, how money was supposed to be. The purpose of money is to be a store of value. But to keep this just as valuable in 20 years' time, I will have to invest it like it is today. I just can't leave it in that safe deposit box, because it will be rather worthless in 20 years' time with inflation. I will have to risk it on asset markets to just keep up with inflation, or buy gold is a good alternative as well, actually. But that's not how money was supposed to be. But I think gold again will return as a safe harbor, you know, where you don't need to take risks just to keep up with inflation. Then the question is always, what will the price of gold be in such a scenario? And it's a flawed question, in my opinion, because the price of gold has nothing to do with gold. It has everything to do with the value of the fiat currencies, and they will be rather worthless. So gold will be valued in terms of its purchasing power again in the future, like it has always been, you know, during 6,000 years of history. And gold will serve as a store of value. We might still have our fiat currency as a medium of exchange, but you know, gold will serve the role that the US dollar is serving today. Because it will be representing payments in full, it will be more stable, and you know, you don't need to hold just claims on someone else. It's the ultimate debt extinguisher. So, you know, concluding, I believe we will see a decoupling of the paper gold market from the physical gold market that will increase over time. And finally, it will all end by the paper market not being able to deliver any physical gold. And then, you know, paper gold will become worthless, but physical gold will once again be a proxy for value, as it is a more stable unit in every sense. It's also a more stable unit to measure things, you know, because really US dollar used to be a weight unit, you know, and gold was the stable asset. And we have been in different situations previously in the history, but this debt bubble, the fiat debt bubble today is much bigger than it has ever been before, and that means that there's more room to fall also than ever before. But in every time in history we've had unbacked paper currency or unbacked fiat currency, it's always been failing. And judging from that, I believe that gold will once again return as for value. So that is concluding my presentation. I will leave some room for questions and discussion here rather than going through why to buy gold. You're already here, so you know most of these already. Won't try to sell it on you. Let's say that we have this promotion. If you want to buy the 1 gram gold bars, also if you want to place an order with us this week and an order about $1,000, give you a 3 ounce of silver if you write gold seminar in the checkout. But I will now leave open for questions and discussions. I was asked in the break, I can start with a question myself. I was asked in the break, I've been talking about gold a lot tonight. So how about silver? How about silver? What is silver's role? The silver market is even smaller than the gold market, much, much smaller. The silver market is worth about, gold was 190 billion US dollars per year on the physical market. Silver market is less than a tenth of that actually. So the silver market is very, very small. Whereas gold is used for industrial purposes, I think 12 to 15% of the gold is used for industrial purposes. The rest is jewelry and investment bullion. It's the other way around with silver. So silver it's about 80% that's used for industrial purposes. It's a very good metal to use in the industry. So silver has the same characteristics as gold basically. It's just that silver has a bit larger risk to it. It's leveraged compared to gold. Usually if the gold price goes up 1 to 2%, silver price goes up more and vice versa. So silver might be overshooting gold, if this scenario I'm talking about here is playing out. But it might also fluctuate more. So, but the silver market is so small, so there's no room for any additional demand to physical demand. No billionaires can buy silver because there will not be any silver available. So, yeah, that's my reply to that. But let's start with some questions. Anyone wanting to question or comment?
Do you have any comments on the drop in the gold price on Thursday and Friday?
Oh, that's short time. I'm looking at the 6,000 years. But
yeah, but I mean, if we're trying to
timing. I'm useless with timing, so whatever I say, you should do the opposite.
Okay.
Well, what I'm trying to do is just that, for my own sake, I'm just accumulating, general savings. So if I get a salary here, from BullionStar, I own the company myself, so hopefully it will do well. I will just place the surplus month by month into gold, so I will just, buy as I go. But the price decrease here, I can just explain it like I tried to do, that is because it's increased demand, meaning that the paper market is losing in confidence, and it's the paper market that's actually setting the price for gold currently. Did you follow on what I meant with the increased demand for physical gold is actually making the price go down in price? Because it's a lack of confidence on the paper market, and that's where the price is set, which is really absurd. And that is missed by a lot of journalists. They're trying to find some sort of reason for the gold price being going down. Oh, it's lower demand. No, it's not. It's going sky high. So it's been very difficult, I believe, for a lot of media and journalists to actually connect the points here, because you have to distinguish the paper market from the physical market.
So when you see a big drop like that, you think it's a reflection of the paper market?
Yes, absolutely. Because that's what we saw between March and May this year, especially. Very high demand for physical gold, and the price dropped 30%. That cannot happen on the normal market. The market is buyers and sellers, almost no sellers and just buyers, and more and more demand, price going down more and more. But I think that is the shift from the paper market to the physical market, and the prices are quite. So that's my take on it, and that is just moving us closer to a point in time where we'll have total shortage of physical gold and silver, and then it will have to be revalued substantially. So yeah. Yep.
Okay, I have a big question. Let's see how you can help me out here. Okay, sure. There's a lot of talk in the collapse by 2014 or even 2015 in USA. Okay, so that's one question. What's your thought on that? But at the same time, I mean, we are in Singapore. we are talking a lot about US dollar, lack of confidence. How exactly will it eventually affect Singapore, where we have a very strong reserve as a country? We have a lot of wealthy people here. And of course, I mean, the government won't tell us, but you can see that the government is really ranking up in terms of their gold reserve. But I don't know where to find that information, because I read somewhere that Singapore Precious Metal Exchange is actually the world's largest physical exchange. I'm not so sure how true that is.
Let me split this up. So first, on the timing of the general economy crashing, basically, 2014, 2015. I can say my time is quite useless there as well, because in 2008, when I started the first bullion dealership in Sweden, I thought everything would transpire much quicker. I thought by now for sure we would have in mayhem and chaos, and we would have been through this period already. So we can see that they been balancing the system decently in those last years to keep it together. And the timing, the problem is that the debt. They have tried to solve a problem with too much debt, with even more debt, which means that the problem has just worsened. And it's the only way to keep the system together under fractional reserve banking, because money is based on debt. So on the timing, I think we have to look at, again, shortages of physical gold, and we have to look at decreased demand for saving money. That is the two indicators I would be looking at. And we're getting closer and closer to that point in time where the total loss of confidence is appearing. I would definitely say within a 2 to 3 year period. But then again, it's better to be a year too early getting gold or silver than a day too late, because when there's no gold available on a physical market, you're too late already. So that's generally what I'm saying. The second question, how will Singapore do in all of that? Well, Singapore official gold reserve is different from the Singapore Precious Metals Exchange. Singapore Precious Metals Exchange is just a private company, a bullion dealer, selling gold. So it's not an official exchange. It's actually just a private company that is sort of trying to portray themselves as some sort of a big exchange. So it's just like I would start a diamond exchange tomorrow. It's the same thing. It's a private company. But how will Singapore do? Well, Singapore is better prepared in many ways. The banks are actually not as bad in Singapore as many other countries. They have reserve assets which are much higher, 30 to 35%, the major Singapore banks. So they are better suited for it. But the problem is still there, and the official gold reserves just being 2% of total reserves is not good, because if we have hyperinflation and the value is deteriorating for all the fiat-denominated assets, Singapore, unfortunately, with a 2% gold reserve will not do too well. So that is my reply to the best of my ability. Yep.
I was reminded when you showed the slide on the government's gold tokens around the world that I believe it was Germany earlier this year wanted to repatriate a large quantity of gold from the US.
Not that large. I think it was 350 tons.
300 tons.
300. Yeah. Well, it's a bit.
And the answer was fine, but it will take 8 years to deliver to you.
Yeah.
Now, am I correct to infer from that that they didn't have that gold in the first place because they lent it out? Okay? And not being critical of your figures, because I'm sure they were sourced by someone else, but that means we really can trust, particularly the US, the amount of gold they really do possess. Is that correct?
Yeah, it's the saying is that Fort Knox is the best kept secret of there being no gold. So that's the reason why they're guarding it so heavily, because they won't let anyone in to see that there's no gold there. And it might very well be true, because there has been no real audit for 100 years or so. Why wouldn't you? They don't let anyone in. So Germany wanted to do an audit of their gold, first of all. They didn't let them in. they let them into sort of a lobby, and they some private viewing room, and they took out a couple of gold bars. And this is a sample. You cannot go into the vault because there's not enough room and for security reasons. So, you know, anyone's guess. You know, it might be, the gold might be not existing at all, but I don't know. How can I know? Or it might be double counted, more likely. So some people are arguing 7 years to repatriate the gold. That is because they don't have the gold. But, you know, I'm just not sure. I don't know. It could also be that, because no, actually, I don't know if you've heard more than me about this, but the Germans seems to be sort of all right with that. You know, they haven't done anything else after getting that reply. It's going to take 7 years. It might also be that if the Germans pressured the US to release the gold quicker, the market would say that, you know, the Germans know something that we don't know, and then everyone would panic, you know. So the gold is not there. So it might be that the Germans even don't know themselves, probably don't know if the gold is there or not, but they don't dare pushing it because they don't want to have this sort of chaotic hyperinflation that might happen very quickly if they said, no, we want it in a month. So, yeah, that's my take on it.
I have a question about the paper gold system that you were talking about. How does this, there have been some commentators who also argued that it is maybe a good idea to have a proportion of the gold investment in gold ETFs and gold-related stocks, and also in companies that mine gold and so on and that. So, what is your opinion on this?
That's how I started. When I first got interested, you know, finding out about Austrian economics, that was about 2004-05. I started to buy mining stocks. I think that's what a lot of people do, you know. We have that sort of reference, so we buy paper assets, you know, buy paper gold or mining shares. Nothing wrong with buying mining shares. It's great. You know, they have been faring quite bad over the last year, and you know, with gold in the scenario I was playing out here, gold being revalued, mining shares should do very well and should be very leveraged, but it's of course also a company who is buying mining shares. I think there's a risk that the government might you know, if they have those windfall profits, the governments are not doing too well in a transition period when gold is revalued. I think there's a large chance that the government will see all of those profits and try to tax them very, very heavily, you know, 70, 80, 90% plus on the profits, and you might have nationalization, things like that. So very, you know, positive generally to investing, because this is investing. Buying physical gold is saving, in my opinion. So, you know, I think you should look into that, investing in mining shares, but also be aware that it's different risk, it's company risk, and there's also government risk that is quite substantial. So, for my own sake, I don't invest in mining shares anymore. I did until like 2008, starting my first bullion company. I don't invest myself anymore because it is, the reason is, I'm not recommending against it, it's just personally I think much better just holding gold and silver, because, you know, it has history on its side. It doesn't have any counterpart risks in that sense. So, yeah.
What about gold ETFs? Would they
Gold
also
ETFs.
class under the paper gold system that you're talking about?
That's debated. You know, they're supposed to have physical backing, but there's a lot of people questioning it and trying to actually, you know, get the serial numbers. Some people saying that it's double counted. The serial numbers are appearing in different places. So you have a counterparty risk still, you know. You can't get the gold. You know, if you have increasing amount of chaos, how are you going to get your gold if you have a gold ETF? You know, is someone going to fly to you, send it in a letter? How are you going to get the gold? You know, you need the gold. When physical gold is returning a store of value, you need the gold. So short term, it might function until the day it doesn't anymore. So yeah.
I have one more question. How
Sure.
do you, what is your opinion on platinum and palladium?
Platinum and palladium, just like silver, is used industrially most. It's especially in the automobile industry. It's catalysts and you know, you have two sides. You have the industrial side, which might not do very well if we have a recession. But then you also have, you know, Russia used to have large stores of palladium, especially, I think, if I'm correct. And they have been distorting those reserves over the last years. So if we have a growing economy, you know, we have growth, there might be, you know, continuous rise in demand and supply actually decreasing. So then it might fare well. If we have a recession, so that the demand is not as high on the industrial side, might not do as well. So it depends on what perspective you have on the economy. Generally, it's not as good store of value as gold. Gold is the sort of risk minimization asset. So personally, I would recommend gold and silver before both platinum and palladium, actually, even though we have higher margins on that. Yeah.
Hi, I want to go back to the relation between physical demand and prices. Physical demand has never driven prices, so far at least.
Well, I covered that before you came, actually. So how the gold market has evolved is that you know, it did until the late 60s or beginning of 70s. But then you had the creation of the paper markets. And that was the miners forward selling their gold, which actually multiplied the supply of gold, pushing down the price of gold. So that was how that was instigated. But up until late 60s, it was the paper market that was setting the price. But the problem was that, you know, the price of gold was going up, and it was not good that the price of gold went up, because then oil price will go up with it, because the oil barons just cares about getting their gold, whether the oil price is low or high. So, yeah. So in the last 40 years or so, it's been basically it has been the paper market setting the price. Yes.
Yeah, but how do you said, you know, with increasing demand, prices tend to go higher. But I'm just trying to see how soon do you think physical demand is going to dictate prices again, given the big money is still with speculators?
Yeah, I think within 2 to 3 years, timing is difficult again. You know, it's happening already. The trend is in that direction with the coupling of the price. This spring we saw it quite clearly, but it goes a bit in cycles. You know, I would think within 2 to 3 years, definitely. Yes. That's the best answer. Yep.
So are you familiar with Martin Armstrong's work?
A bit, yeah, a bit.
So according to Martin Armstrong, gold bull market started in the year 2000, it was around $200, and it kind of peaked out in September 2011 at 1900. So you look at a graph of gold technically, the graph is really bad. The uptrend has been broken, and gold has been sort of trending in range and getting lower.
Yeah.
Martin Armstrong has said that gold's uptrend will not resume until gold tests its 1980 high of, you know, $800-ish dollars. So I was wondering, you know, what are your thoughts on that? Because if you look at a graph, just technically speaking, it looks like gold will not, you know, achieve its 2011 high until a few years later, 2017, 2016 maybe. And gold has a very high correlation now with the US dollar, and the US dollar is rallying.
Yeah.
So, and you can see, if you look at the price of gold currently, it's gold is rising only because of hedge funds doing short covering. That's why you see, you know, there's no sustained uptrend, right? There's no hot money coming to gold right now. It's mainly just, you know, gold bugs, really.
Well, no, I disagree. I disagree mostly with Armstrong. Yes, because he's using a very failed measuring stick. He's measuring gold in terms of US dollar, whereas gold is the stable unit of account. US dollar is worthless as a measuring stick. So that's my first objective. And with the price of gold going up and down, no, it's not the price of gold going up and down, I would say. It's some fluctuations in the fiat money, mostly downwards. Always 100%, you know, over longer term periods, but for the last 100 years it's only 98%. But whereas gold is being stable, you know, you still have the same purchasing power. So that's my first objection. But then again, you have a sort of timing of events when things are going to happen. You know, I don't know, and that is why I own gold. You know, that is the reason. I don't try to predict. That's why I own gold. I just know that the system will we have today is so flawed. You know, even, you know, we also talked about Bitcoin in the break here. Any other system and the fractional reserve banking system we have today would be better. You know, this is the most flawed system there can be. Money is created out of debt and it's supposed to be paid back by interest. It's just that if I have $1,000 and it's supposed to be paid back with interest, you know, 10% interest, let's say, that's $1,100. But where are we going to get the additional $100? It doesn't exist. It has also to be created by debt. So the debt has to go up exponentially, and it is, and it will break. So I'm more, you know, looking at it longer term instead of trying to time, because I did play the stock market just like 10 years ago now. I did even day trade and all that, and you don't sleep very well, do you, when it's like adverse. So, you know, I haven't been trading nothing in the last 6 years. I've been sleeping much better.
Well, I guess the thing is, well, everyone here knows the truth, right? But, you know, other people, they have no idea, even if you explain it to them, they sort of don't believe it.
Yeah, yeah, so, but we are a growing number of people, you know, understanding Gold's role. It's just that one recommendation I can give is that not to try to think in terms of you know, fiat currency. Try to think in terms of purchasing power and in terms of gold. Because if the return of investment is sort of luring you in gold, you have a too short time perspective, I would say.
Well, I mean, ultimately, if you look at thousands of years of history, gold has at times been overvalued. You can buy more of your gold, right? So obviously, you want to sell your gold at that time to buy stuff. So, I mean, but if you look at a long period of time, obviously, it's quite constant.
Depends on what you want to do. You know, if you're sort of investing in gold because you want to buy additional cars, or if you just put your surplus in gold because you want to have it stable for more sort of generation. It depends on the perspective. But that is all individual, you know, and I'm just telling what I believe and where I stand. That is a bit longer term.
Also, actually, according to Martin Armstrong, no reserve currency has ever gone into hyperinflation. So, I'm just
I would disagree with that. Well, which are the previous ones?
Well, like the British pound is still in existence.
It
was severely devalued, but still in existence.
Yeah, still in existence. But there's one currency that has not been hyperinflating, and that is gold. And it has been appreciating over 6,000 years actually. So you have the same purchasing power as you had, you know, in 3,000 years ago. The saying is that you can buy a nice suit for 12 ounces of gold. You can do that in the Roman times, as you could do 100 years ago, as you can do today. And the suit is just getting nicer and nicer. Yeah, it's good.
I'd like to ask a question about exchangeability of gold with the fiat currency, because when we put our money in gold, I mean, some of us might want to take it out at some time. I mean, we need to eat, right? I mean, so you can't go to the hawker center and pay by gold.
Yeah.
So I think the thing that troubles some of us is that in the short term, let's say, you know, I want to get married, I want to get married tomorrow, and my wife will say, can you please sell all your gold? So the thing is that it's a bit difficult to change it in the short term, because I mean, there isn't a very liquid market. That's the first thing. And my other second question is when there's a real crisis and it's going to happen maybe in our lifetime or our children's lifetime. And I foresee, right, there will always be the government intervening to stop people from, because the people who have a lot, let's say I have tons of gold, are going to be filthy rich, and people are going to definitely try and steal your gold, kill you.
Socialize it or take it.
I think governments are going to stop you from changing that amount of gold into fiat currency. Because if you are able to exchange, what do you think will be the
starting with the terminology then a bit again, because taking profits, you know, I think that is the flawed way of thinking again. So not to offend, but the way I'm thinking is that you take profits into gold. So if you invest, for example, in mining shares or in stocks or in property, you take your profits. Well, do you want fiat currency on the bank account? No, you want gold, because gold is much more stable as a unit of account and as a store of value. So taking profits from gold into fiat currency, that's not good. What are you going to do with that? It's just going to deteriorate and destruct. Of course, short term, you need to be able to eat, like you say. You need to go to August after. And short term, I think that the fiat currency will still be there. Because, you know, then the policy makers can still play around with it. It's just that they can't live, you know, they have to live more within their means. They can't over-consume just as bad, but if they were, it would result in a dishoarding of the actual gold. Second question, you know, the governments are always trying to attack you if you're doing well, if you're rich, they want to take part of your money, and, you know, how is there going to be confiscation, you know, will they, you know, sort of attack you? What I'm trying to say is that I don't think that is a necessity that is going to play out that way, because many of the major central banks in the world today have a substantial amount of gold holdings as the reserves, and they will actually do good in a scenario where gold is revalued. And the fiat assets, if you have 50-50, many central banks, let's go back to that slide, they have a significant part of their reserves in gold. And, you know, you can see here, the United States even have 70% of their reserves, Germany 66%, Italy, France, and interesting country here is Greece. Greece, 76% of our assets in gold. So if we have hyperinflation in fiat currencies and we have revaluation of gold, Greece is going to do well, actually. It's very interesting. It's not a lot of people seeing that perspective. So, but again, some countries here, and you see China, they're trying to accumulate. That is, yeah, 54 tons. They're trying to accumulate. So a lot of people saying, oh, they might have a gold backed Chinese currency. Yeah, they might, but I don't think they want to do it now because they have so little gold in comparison to the total reserves. I think they want to delay it as long as possible and accumulate a bit of gold and tangible resources here and there. And domestically, they won't export anything, and they will import sort of a back way. You know, they're smart. They will import a back way so that people are not finding out about it too much. They try to do that as long as possible because they're really heavy on the US bonds. US bonds is 1.3 trillion out of their 3.5 trillion in reserves. So it's just too much. They don't want anything to happen just yet. Did that answer your question?
Yeah, my scenario is that, like you mentioned, the banks have so much gold. I mean, it's at reserve. I mean, you're not looking at the US equal. So if the currency really collapses, then they might use this gold, I'm not too sure, to recapitalize their banks.
Yeah, exactly. If it exists.
If it exists.
And that's,
yeah.
Yeah.
Okay, we take comfort in that at least.
Yeah. So, you know, but the central banks, it's actually interesting because Liberty Silver in Sweden, my Swedish company, we have actually, there's been a lot of attention now after Germany's repatriation, you know, whether the gold exists or not. And the Finnish central bank actually released information that about their gold, and that only half of it was actually leased and lent. So now we in Liberty Silver, we sent questions to the Swedish central bank. We have Sweden where 28 positions, 7% of their total reserves. So we sent questions to the Swedish central banks. You know, why don't you publish where you hold your gold? And so they actually did. And they're holding 88% of their reserves abroad. So only 12% in Sweden. And Sweden is a quite stable country. There's been no wars in 200 years, and so on. And so we were saying, you know, shouldn't you audit it? And they're coming back saying that they are going to do an audit. The question now is, of course, how are they going to audit it? The US didn't let Germany into the vaults even to audit. Now we're saying they're going to audit it, and they're going to go, and we explicitly asked them, so you're going to go to the different vault and do a physical audit? And they have replied yes. And that was just yesterday they replied to us, and now there's media exposure of this. So it will be very interesting if the US not letting in the Germans, are they going to let in the you know, small Swedish people there? You know, it's you know, it's fairly unlikely. But the interesting thing is that the Swedish central bank was actually trying to be very transparent, and they're saying that during those audits, they will also release the records publicly. So it's for everyone to see. And we even asked them, if you're uncertain whether it's gold in the gold bars, it's been, rumors about tungsten, gold-plated tungsten bars, 400-ounce bars. Will you test the gold bars? And we said, yes, if we feel we have to. And, this is interesting, because that is the trend now, that the central banks, they try to give a perception of being transparent. But it will be interesting to see what happens. It's unlikely that they will do a real audit, because they, whether the gold is fair or not, they won't be let in. So we just have to follow up on that now and make sure that they actually fulfill their promises.
Did they give any time frame?
No, we didn't give any time frame. But they're saying that they already have been auditing. So we asked them, will you release the records publicly? And they said yes, but they haven't released it. So, they didn't give any time frame. That will be our next questions to them. So, yeah, they're very interesting times.
You mentioned that there's strong demand of physical gold.
Yes.
And yet the currency, the pricing part, because of paper,
yes,
is actually going down. What's your comment on GATA and John McGuire accusing and saying that it's the federal government, the Fed and the Bullion Bank that are pushing down, shorting the price?
Yeah.
I support them.
I support their cause a lot, but I think they are missing the point a bit actually. That I support their cause a lot, and I agree with most things they say, but they focus a lot on the commodity exchange on COMEX, and I think that they are missing out a bit on how the, without being too harsh, how the gold market is working really, because LBMA is the major gold market.
Yeah, but
LBMA is bigger.
Just going to check. I thought the setting of the price, the spot price, is not with LBMA, it's with COMEX.
COMEX is much smaller than
Correct,
LBMA.
yes. But the setting of the spot price, is it at LBMA or is it COMEX?
So there's not actually any one specific spot price. There's different markets, but there's different spot markets and different futures markets, commodity exchanges. It's not actually one price, but basically it comes down to one price, because otherwise you have arbitrage opportunities. But but what I would say is that the LBMA market, much more paper gold is actually traded on that LBMA spot market than what is traded on the COMEX. The COMEX is a bit of a sideshow, but it gets all the attention, perhaps because it's in the US as well. So spot for course, and there has been price manipulation, but whether they are sort of pushing down the price by increasing the supply in the paper markets, yes, for sure. Because you have a futures market, sure, and the justification originally for that was for the miners to forward sell the gold, but today the banks can create paper gold without any backing as well. So they are correct that the supply of gold, paper gold, can increase without any backing. And that's absolutely correct. But I just think they should study the LBMA market a bit more. Also look in that direction, but mostly I agree with the perspective.
Continuation to this one, the production, average global production of physical gold is approximately $1,100 US. So if
the production price,
production price is approximately $1,100 US from drawings. If the paper market goes below this, what happens to physical gold?
Supply will decrease. This is that, and the shortages will appear even quicker.
Or other way, we should take it as 1,100 my base price.
I think
price cannot go below the production price.
It cannot. Yeah, well, it can. It can short term, but I think shortages will appear quicker. And that is the point you want to look at when there's a big shortage, because then there will be hyperinflation approaching the price of gold we're valuing on the physical market. But The production price, I think there's strong interests of keeping the paper market together as long as possible. And in doing so, the price can't go too low, because if the paper market price goes too low, there will be too much demand for physical and there will be no physical around. So
Production company will stop producing.
yeah, they will stop producing, and then it will be even more shortages. So I don't think it's in anyone's interest to let the price go much lower than currently, actually. Yeah.
My second question is, what is the business model of BullionStar? You are buying an inventory and you are buying at a fixed price and selling at a fluctuating price.
No, we are buying at a fluctuating price in terms of spots, and we're selling at a fluctuating price in terms of spots. So it's basically, if we buy for there's a premium, of course. If we buy something for spot plus 1%, we sell it for spot plus 1.5%. It's very big margins.
0.5% margin is not good enough for a business. In this,
this
year,
on
where your gold has dropped 30%.
Well, it builds on volume. We need to have volume. What we have done is that we are very strong online, and our trading system is very automatic. So a lot of the things where other companies might need to have manpower, we have optimized. So it's very automated. Our margins are very small, it's very thin. It might be a bit more than 0.5%, but not more than 1 to 2%. So it builds on volume. We have to get volume for it to work. But it's very automated, and it's a business model that has been working well for us overseas now for some 6+ years. Liberty Silver is now equal. Sweden is not a big market, but Liberty Silver is equal biggest bullion dealer in Sweden. And we've been growing a lot, but we have 2 employees only, 2 employees. And we have quite a bit of volume. So it's very automatic. It's the handling of a physical gold and silver that we need to do. Much everything else is automated.
My question is, do you hedge on paper market?
No.
Against the physical?
Never.
Okay, my question was that.
As opposed to most other bullion dealers, 90+%, we do not. Because I don't believe in fiat gains. I believe in real gains. And real gains are gold gains.
No, you are hedging physical gold against paper gold.
Not hedging. Well, what we do is when we have orders coming in, we replenish our inventory as soon as possible. So we try to be 100% in precious metals as much as possible. Yeah. So then you can say that we have a risk in terms of fiat paper when the price is going down, right?
That's what 30% gone down.
Yeah. But what happens and what has happened is that, of course, we are turning our inventory very quickly. So when the price is going down, there's increased demand, and we're turning the inventory very quickly. So yeah, sure, we are affected to some extent by the price going down. We have been doing fairly well over this year, even though the price has been going down so much, because we have a very high turnaround time on our inventory. So it does affect our margin a bit, but not substantially. And I wouldn't, going into this scenario that I'm explaining here, and if I were to lock in profits in fiat currency, it would be worthless down the road, in my opinion. So I would never do that. So, yeah. So we'll take 2 more questions. It's 8:10 already, and we need to be out of here soon. So yeah.
Gold has traditionally been hoarded, and silver is being consumed. Even you can find it even in your clothes and in your Apple iPhones. Looking at the gold-silver ratio, which has ranged from 15 to 100, gold is relatively expensive compared to silver. And traditionally, precious metal, only gold and silver are considered money, has been used as money in the last 6,000 years. Right. So my question to you is, you mentioned that you spend money to buy gold. Why not silver?
Well, I agree.
Because there's a saying that if you want to buy gold, buy silver.
Yeah, and I agree. The gold perspective I've had here tonight is more because the central banks are holding gold, and I think gold will actually recapitalize the system to be the sort of ultimate store of value. But as a private individual, holding silver makes sense. Just for the reasons you're saying here, the gold to silver ratio is higher than what it had been historically. And actually, it's different figures here, but the total amount of all silver produced is only somewhere 3 to 5 times as much as gold, but the price is still so much higher. You know, it's also based on demand and uses, of course, but silver is definitely undervalued and probably undervalued compared to gold too. So I'm just saying, and I'd rather sell silver also because we have better margins on silver actually, despite silver. But what I'm saying is that gold is more stable over a long time. Silver is fluctuating a bit in terms of gold also. So it has some risk, but definitely if you're interested in buying gold, buy silver. I agree. That's usually what I tell people. Yes. Last question. Someone that hasn't asked any question before. Yeah.
So in the long run, it's better to buy silver.
It has more leverage, but it also has a bit higher risk. Yes. Potential is greater because the silver market is much smaller than the gold market, and there's not a lot of silver around. Okay. Yes. All right. Okay. One last one.
I just have one question. When the correction happens, there is likely to be some unrest and the shrinking of economies around the world. There is also a chance that the governments will try to confiscate gold. So my question to you is, does the Singapore government keep track of whom bullion traders sell their gold to, and if so,
no,
they don't?
There's no general reporting requirement for us or any bullion dealers in Singapore. Of course, you know, like any company, of course, IRAS could theoretically look at our accounting, like they could for any company anywhere in the world. But there's no general reporting requirement in Singapore, and I don't know, but I think with the Singaporean government starts to sort of get this, exempting gold, wants Singapore as a gold hub. What I'm waiting for is just for them to increase their reserve, their official reserve now as well. Because it's not a lot of, most countries, overseas, especially in Europe and the US, they are adding restrictions. It's becoming more and more difficult to be a bullion dealer. You can't transact in cash, and there's more and more reporting requirements and more rules to make life difficult for you. Because, it's competing with the fiat currencies, and they want more and more control. But Singapore seems to be going the other way around, which is why we are here in the first place. So the government is quite friendly, and I think they're starting to catch on to this, which is a good thing. Okay, so it's now 8:15. So thank you very much for coming, and see you again.